Live from Singapore, this is Insight with me, Haslinda Amin, the show where we dive deeper into the stories that matter with crucial context and sharp analysis. South Korea's political tensions escalate with protests, thousands of police deployed, and a standoff at the presidential residence as investigators move to arrest impeached leader Yoon Suk Yeol. Meanwhile, Asian stocks edging higher, bucking a fifth day of declines on Wall Street, the dollar easing from a fresh two-year high. We'll assess all the political risk and market strategy with our special guest this hour, Yardeni Research President Yardeni, find out whether he still thinks China is uninvestable despite Beijing's stimulus efforts. To our top story and the latest on the standoff outside the residence of impeached South Korean President Yoon Suk Yeol. Authorities are seeking Yoon's arrest after his shocking martial law declaration in early December, which led to his impeachment. Yoon has repeatedly refused to appear for questioning as he's been probed for insurrection, leading to the warrant for his arrest. Bloomberg's chief North Asia correspondent Steve Langle is with us. And Steve, what's the very latest? We know that the spokesperson has denied that confrontation reports.
Yeah, well, there is still high drama on the streets of Seoul, obviously with temperatures below zero. There's lots of people gathered around the residence of President Yoon. And again, he is going to fight this to the very end. He vowed that on New Year's Eve. He said he will fight this to the end against anti-state forces, as he puts it. And also his legal team has already warned last night that any attempt to try and get through the security cordon that he has of more than 1,000 supporters around his house, as well as what some local media say is a military unit, they're going to prevent those investigators from the CIO, which is the Corruption Investigation Office of higher officials. About 20 of them are said to have been trying to get into the residence and essentially execute the orders that were issued on Tuesday, the arrest warrant that was issued on Tuesday by Western Seoul District Court. Now, that arrest warrant has a shelf life of a week. It will expire on Monday. So they have attempted physically today to go in and serve that warrant and detain the president. They would then have essentially 48 hours under that warrant to either formally formally arrest the president or release him. So time is of the essence right now. We're hearing, though, that according to the CIO office, they're going to have a press conference later this afternoon to explain what the latest is. They are saying that they are being blocked from getting into the residence to serve that warrant. So again, we're at a standstill, high drama that could play out over the course of the weekend.
That's right. An update on an ongoing saga. Steve, as you said, his lawyers have denounced the arrest attempts. What are we hearing from Yoon himself about why he's not cooperating?
Well, I think he's buying time definitely right now, and also his legal team is saying the impeachment, the arrest warrant, and the whole process to try and get him out of office officially is illegal and also invalid. So that's his position right now. There's a lot of procedures that need to be met, or requirements that need to be met, and procedures that have to be taken out in order to carry this out. Now, an arrest obviously would be a setback for him. He already has been stripped of his executive powers right now. He is still entitled, the president. And keep in mind, at the backdrop of this as well, once the impeachment was passed on December 14th by the National Assembly, that handed the ball off to the Constitutional Court, which has already begun deliberations on the validity of that impeachment and whether they would authorize his expulsion as president president and then essentially call a new presidential election possibly in spring. We're getting ahead of ourselves because the Constitutional Court is still deliberating. Right now, the matter at hand is on the streets outside of Yoon's residence, where he is assumed to be residing right now in central Seoul. And again, there's only 3 days left until that arrest warrant expires on Monday. So those investigators, with the possible aiding of the police, there's some 27,000 police officers said to be outside as well. That's going to play out over the next 3 days, whether they can get inside, get to the president, potentially arrest him and begin their 48-hour investigation to determine whether he is formally arrested or he's released.
Steve, thank you for the update. Our Chief North Asia correspondent, Stephen Angle, and our subscribers can also turn to the Bloomberg for more on this story. Go to TLive Go to get commentary as well as analysis from our expert editors. And the turmoil in South Korea highlights rising political instability around the world ahead of Donald Trump's return to office. To discuss the market implications in 2025, let's bring in our guest for the hour, Ed Yardeni, President at Yardeni Research. Ed, good to have you with us. As we said, what we're seeing in Korea is just another sign, a signal perhaps of what's to come, and that is volatility. We're talking about geopolitical issues coming to the forefront in 2025.
You're absolutely right. You look around the world and there's a lot of chaos, a lot of political instability. People are clearly not very happy with their governments. What's going on in South Korea is clearly a mess. But we also have political instability in other democracies like Germany and France. And meanwhile, we've got a lot of geopolitical crises in the Middle East between Ukraine and Russia. And it would be obviously a much better situation if the democracy of the world were stable and united and in trying to stabilize the world. But they're having enough trouble just stabilizing the home fronts.
So how do you strategize, Ed? Does it change the picture for you? Does it change your strategy, or is it just noise?
Yeah. Well, I've been in the stay home camp versus go global since 2010. In other words, from a U.S. perspective, I've been recommending that U.S. investors overweight the U.S. relative to the global economy. And oh, by the way, for global investors, I've been basically saying the same thing. You want to overweight the United States. The United States, we certainly have plenty of our own problems, partisanship and so on, but we're carrying on reasonably well. The economy has performed extremely well over the past 3 years in the face of the tightening of monetary policy. So there's a certain resilience in our economy, and our economy continues to do well despite our politicians. And I'm not sure that other countries are as fortunate that their economies can prosper and do well if they've got political instability.
Ed, before we get to the U.S. market, I want to take a look at the Korean market. When you take a look at how the Kospi is doing today, it is up 2%, solid 2%, and the Korean won is also seeing some strength. I'm just wondering if perhaps you think, Korean assets have found a floor.
I think they very well might have, but this is a very dynamic and unstable situation. So I think an investor that jumps in here looking for opportunities may find that the opportunities will be even better if you just wait a little while to see how the smoke clears here. Clearly, you have traders willing to take a bet that the worst of this news is out, and that from here on things will progressively get better. But it could just be a day trade situation. It could just be that the shorts made a lot of money and they're covering some of their shorts, and they could very well put them back on depending on the news flow out of South Korea.
But valuations are looking really, really cheap. 12-month forward PE is just 8. Surely you can find some opportunities to buy even currently, even right now.
Well, I think you're right. The problem is global investors are chasing all kinds of AI-related themes. And South Korea, of course, is a powerhouse when it comes to technology. But a lot of the technologies that South Korea excels in have been commoditized, whereas AI, the digital transformation, data centers. Those are sort of the new kids on the block, and everybody wants to invest in those kind of areas. So I think you're right. For a long-term investor, there are certainly opportunities. But in terms of explaining why it is that there's an 8 multiple on South Korea, I don't think it's just the political situation. I think it's also that in many ways, what they sell in global markets has become commodities with very low margins.
When we talk about the markets, everybody's waiting for clarity when it comes to Trump's policies. And Korea is one economy that is vulnerable to those policies. It may be impacted, it could get hurt by Trump's trade policies. How are you assessing the possibility of that and how that may weigh further on Korean assets, bearing in mind that the USD is likely to trend higher later in 2025 as well?
Well, I think, this relates to the conversation we just had about whether you want to jump in here, because on January 20th, that we'll have Donald Trump in the White House. And that very same day, we could have 20, 25 executive orders where maybe a third of them will be all about trade and about tariffs. And that'll really unsettle the markets and a lot of our trading partners. On the other hand, the dollar might actually firm up on that. And the stock market may not go down all that much, if at all, in the United States, but other markets, I think, will be much more vulnerable to a widespread tariff.
Will it be the same story for the other emerging markets as well? If you're talking about continued U.S. exceptionalism, if you're talking about a strong U.S. dollar policy, emerging markets may continue to feel that impact. They've underperformed, developed markets for the past 7 years.
Well, again, that's my preference has been not to overweight emerging markets in particular. Especially in recent years, what we've seen is that commodity prices have generally been pretty weak. And there's a very strong correlation between the emerging markets stock price indexes and the commodity prices. And I think the commodity prices have been weak because one of the most important, maybe the most important emerging economy has been China. Maybe it'll become less important and India will become more important. But China has been a big consumer of commodities. And so the weakness in commodity prices tells you that China is weakening. And China bought a lot from Korea, bought a lot from Japan, and bought a lot from Vietnam. And some of that trade is diminishing. And on top of all that, Trump is about to impose some tariffs.
So stay away from EMs for now, but there are bright sparks out there.
Yeah, I mean, as you said, valuation, they look really quite attractive, but it's hard to get wildly excited or excited at all about emerging economies in a world where the dollar is strong, where the Fed may very well have turned from dovish to less dovish, at least talking about a pause, and put that together with what's going on in China. And again, it doesn't make a compelling case for some of the emerging economies, especially the commodity producers like Brazil, for example. Even developed countries that are commodity producers like Canada and Australia, it's hard to get excited about their markets in a world where China's weak and commodity prices are weak.
Hang tight. Ed Yardeni, president at Yardeni Research, is staying with us. Up next, we turn our focus to the U.S. economy and the potential market impact of the incoming Trump administration. Keep it here with us. This is Bloomberg.
U.S. exceptionalism continues. The economy is strong. It continues to surprise on the upside. We are continuing on the Mag 7. We think the large cap theme is still relevant given Trump policies and the mindset. We think growth stocks will still continue to benefit.
U.S. stocks doing well on a relative basis, if you want to call it exceptionalism. I guess that's one way to look at it. But we also, in all seriousness, do see some relatively better growth opportunities here in the U.S. than internationally. And so we do think that will help U.S. stocks and U.S. stock investors going forward.
Trump 2.0 is going to be a catalyst and very positive for the capital markets, particularly, as you mentioned, U.S. exceptionalism on the equity market growth as well as U.S. dollar. So to that extent, I think that is a positive aspect.
Some of our guests sharing their insights on U.S. markets. Now, the U.S. economy, as well as the equity and bond markets, have performed exceptionally well in recent years. Investors are counting on U.S. exceptionalism to keep driving returns. Let's get back to Ed Yardeni, president at Yardeni Research, to discuss more on that. And Ed, we talk about U.S. exceptionalism. We've seen gains for 14 years. Why would that continue in 2025? I mean, valuations are already high.
Well, I've been talking about the possibility that the current decade will turn out to be the roaring 2020s. Obviously, I'm hearkening back to the roaring 1920s. I don't think it's going to end as badly as it did back in the 1920s, but I think the similarities are the tremendous amount of technological innovation, increasing productivity, which in turn increases the purchasing power of consumers, and it kind of feeds on itself. And I think we're in a productivity growth boom. I think we're not just starting it. This is not a forecast. This is just an extrapolation of what's actually been going on. The productivity growth rate on a 5-year trailing basis was only 0.5% back in 2015. Now it's 2%, and 2% is kind of the average over time. And I think we're going to go to 3.5%. And the wonderful thing about productivity is it boosts real GDP growth. It keeps a lid on inflation. It gives workers real wage gains. And on top of everything else, profits go up. So it's a win-win-win-win situation all across the board. And I think the reason it's happening in the U.S. is we've got a shortage of skilled labor, and we've got an abundance of technological innovations that can augment the productivity of workers. And I was thinking about this before AI kind of came on the scene in late 2022, and AI only helps that story.
You got to imagine, though, that the rally will not go in a straight line. After 20% back-to-back returns, there must be some correction. I mean, that could be a correction of what, 10, 15%, 20 even. Right. I mean, how are you looking at it?
I'm looking at it exactly like that. I'm thinking that the first couple of months of this year are going to be volatile, and there could be a correction. It may actually have started all the way back on December 6th when we made an all-time record high in the S&P 500. And I think we're in a period here of lots of uncertainty, a lot of known unknowns. We know that monetary policy has been easing, and that at least last year they were thinking about continuing to lower interest rates, but at the end of the year, they started to back off, and now they're probably in a pause mode. And we don't really know when they might resume lowering interest rates. I think if the economy continues to perform well with inflation remaining even somewhat above 2%, there's really no reason for the Federal Reserve to lower interest rates. And so the market's been feeding on expectations of several rate cuts this year, so that the market may have to sort of discount that it's not going to get the sweeteners, the sugar high that we've gotten from monetary policy. And then the big known unknown is how all these various policies that the Trump administration is likely to try to implement, how they will all interact. You know, they say when you don't feel good and you take some medicines for it, you don't want to take 5 different kinds of medicines because you don't know how they're going to interact. And that's the issue we have here with all these policy proposals: deportation, deregulation, tax cuts, tariffs. We don't know what the net impact will be on the deficit. I happen to believe, and it's just a belief, there's no way to really be scientific about it, but I happen to believe that it'll all end well. But it's going to take a few months to see exactly what we get. And oh, by the way, the Republicans are perfectly capable of screwing up a majority situation as we're seeing already. So there's a lot of moving parts here.
You've talked about how you expect the S&P to get to 7,000 by the end of 2025. Are you sticking with that? And what will take us there? Is it the Max 7 again? Do you see a broadening of this rally?
Well, you know, we've been all waiting for this market to broaden. And for a while there, we had a couple of episodes where the market did seem to broaden. The small cap, mid cap stocks were doing better. The Russell 2000 were doing better. And then kind of all fell apart at the end of last year. We didn't get our Santa Claus rally at the end of the year. Maybe it's because we got it in September, October, November, and by the time we got into December, people started taking profits, and the market just had a lot of good news. You know, bullish sentiment is extremely high, so we kind of maybe ran out of buyers at the end of last year, and that may very well continue to be the case early this year. But having said all that, I think, again, the economy has demonstrated a remarkable resilience over the past 3 years in the face of rising interest rates. Now the Fed is no longer raising interest rates. They're thinking of, they have already cut rates by 100 basis points. They're cutting some more. The offset is the bond yield has gone up 100 basis points. So we have to get that straightened out. But I think what's going to drive the market higher is earnings. I don't want to see it go higher in valuation because everybody agrees that valuation is stretched. But I think S&P 500 could earn $285 a share this year, which is the top of the strategist leaderboard in terms of expectations for what earnings could do. And that's because of the roaring 2020 scenario, the productivity story that I'm telling.
Ed, one eye on Trump, one eye on the Fed, and markets pricing in less than 25 basis point cut in 2025. Are they right, Ed?
Well, you know, at the beginning of last year, the market was looking for 6, 7 cuts. We didn't understand why the market was doing that. We thought 0 cuts made sense, or 1 or 2 at most. And that's basically we had, I guess, altogether 3 rate cuts that added up to 100 basis points. And we felt that when the Fed moved in September 18th to cut by 50 basis points, that it might backfire and we'd see bond yields go up. And that's exactly what's happened. And now the market started, the expectations at the end of last year was that we'd have several rate cuts. And that was fueled by Fed officials saying that that's what they thought too. And now everybody's backed off on that. And I think, yeah, 1 to 2 is possible, but I think 0, none and done may also be very possible if the economy continues to perform as well as we think it will. And a lot of that has to do with the consumer. There's a lot of people my age, baby boomers, that are retiring, and they are sitting on $75 trillion of assets. Just a tremendous pileup. It's the richest generation ever, and they're spending it, and that's keeping the economy growing.
Linked to that, Ed, I'm just wondering what your projections are for yield. 10-year yield, some say, could get to 5, could get to 6. What do you think?
Well, I don't think we're going to get to 6. We could revisit 5% for a day or two, which is what we did last year. I think last year we had a glimpse of another risk to the market here, and that's a potential debt crisis. When the bond yield went from 4% to 5%, in September, October, November, that was a very short sell-off in prices, a very short surge in bond yields. That was disturbing, and it was a sort of a sign by my friends, the bond vigilantes. I named them back in. Yes.
We'll leave it there for the moment. Ed Yardeni, president at Yardeni Research, is staying with us. Still ahead, as Beijing plans for the export restrictions on critical minerals, the U.S. is considering a rule to limit or ban Chinese drones. We'll get insight slightly later. This is Bloomberg. Welcome back. You're watching Insight. China says it will expand a consumer trade-in program to mobile phones and other gadgets, a plan to be funded by more ultra-long special bonds. The National Development and Reform Commission made the announcement a short time ago. Our China correspondent Min Lo joins us now from Hong Kong. And Min, how significant are these measures?
I would say it's pretty significant because we know China had first introduced this cash for clunkers program last year around March and April to provide subsidies for cars and home appliances, trade in, and it has really been this big driver of consumption last year, especially at the big shopping festival like Double 11 or the National Day, Golden Week holiday. Household appliances has been one of the top best-selling categories during those periods, but analysts have for a long time been saying that it's going to eventually run out of steam because you think about how often you actually change your fridges and your microwaves. You don't buy those every single month. And so expanding this program to include mobile phones and other gadgets is going to help lift consumption, address perhaps some of the overcapacity issues in the manufacturing industry. And we saw that knee-jerk market reaction earlier this morning, both Hong Kong and Hong Kong and China markets really on the rise. But we are already seeing that cautiousness trickling back in because you can see CSI 300 reversing those gains. We are still seeing some optimism in the Hang Seng Tech, but I believe that is really slightly skewed by the big jump in Xiaomi that we were already seeing even before this news break. That was partly because Xiaomi had set a very ambitious target for car deliveries this year, and there you see Xiaomi really jumping very high this morning. But the other phone makers like ZTE and Honor really still trading to the downside. So some cautiousness and perhaps skepticism about whether these measures will be enough to counter some of the broader macro headwinds that China faces.
Min, as we await Trump's return to the White House, China now planning export curbs on battery parts, mineral technology. Talk about tit for tat.
Yeah, so China is now mulling the banning of battery cathode material preparation technology, as well as some of the processes, the technologies used to extract lithium and gallium. So obviously these are critical to the making of EV batteries. For example, gallium are used in cathodes as well. And this comes as the U.S. has been trying to build up its own domestic EV supply chain as they impose these sky-high tariffs to really block out Chinese EV makers. And there you can see that China is one of the top suppliers for many of these critical minerals. While it is possible to get them from other sources, it is going to be more expensive, and China has already banned a number of these minerals from being sent to the U.S. That is as part of retaliation against Biden administration's announcement to expand those tech restrictions on China. So a lot of tit-for-tat retaliation going on here.
Min, thank you. Bloomberg's China correspondent Min Lo. As U.S. President-elect Donald Trump prepares his second administration, American companies will be keeping a close eye on U.S.-China ties. Ed Yardeni, president of Yardeni Research, is still with us, and he thinks the promise of China's market has faded as its once booming economy hits trouble. And Ed, you're saying China remains uninvestable.
Yeah, I think that's really the message from the bond market. I mean, the bond yield's down to 1.6%. I think that's a clear indication that the Chinese government has overstimulated the economy, too much debt, too much excess capacity. And then on top of all that, the rules change on a regular basis over there. I think China did extremely well when the government allowed market forces to work and for entrepreneurial incentives to work to create more prosperity. But somewhere along the way, the decision was made that maybe that's not the way to go anymore. And it's not a good environment for a lot of businesses. And this is not just my opinion. I think the Wall Street Journal just ran an article saying that a lot of companies, U.S. and other companies, are deciding that the China market just doesn't have the potential that they thought they would have, and there's too much government intervention in trying to run one's business over there.
You talked about how the bond market is suggesting all of that. Some now suggesting as well that bond yields could test 1 before the end of the year. Might it even get closer to 0?
Yeah, I think it could get closer to 0. I think it's got to be disturbing to the government to basically announce that they've got another fiscal stimulus package, and to see the bond yield continue to go up is certainly not a vote of confidence by the fixed income markets that this package is going to do much. In addition, I'm watching some of the property stock prices in China, and they rallied for a little while late last year, and now they're starting to fade away. There's a story floating about, I think it was a Wall Street Journal article saying that something like $18 trillion of losses have been incurred by Chinese investors in the real estate market, much bigger than the losses we incurred during the great financial crisis in the United States. So I think China's kind of experiencing what Japan experienced, what the United States experienced, but maybe on a bigger scale. And a property debacle takes many years to kind of clean out and to overcome. Meanwhile, it continues to weigh on the Chinese economy.
What do you make of the contrast between China's bond and equity market? And I mean, we take a look at the MSCI Asia-Pac, or rather the MSCI China index and the CSI 300 index. They had the best year in 4 years in 2024.
That's after several really bad years. And if you look at the chart, it's not a chart that suggests that being a long-term investor has been very profitable. There have been lots of ups and downs, and you have to be almost a trader to get any sort of positive return on it. So yeah, you're absolutely right. It's had a good 2024, especially later in the year as the government came in with some monetary and credit stimulus programs. But now it seems like they're running out of magic here. That if the fiscal stimulus can't do the trick, then what's really left? And they really need to stimulate their consumer spending. They know that. But it's not working because, again, the Chinese individuals, households have a tremendous amount of money saved in their apartments, and the apartment values have gone down. The market is illiquid. It's hard to sell it. And if you sell it, you take a big capital loss. And meanwhile, consumer confidence is extremely depressed in China. So it all goes really back to the consumer. And if you can't get the consumer going, then they have to continue to rely on exports, and now they're getting the blowback, the backlash from the rest of the world, and the rest of the world is saying no more dumping of Chinese goods in global markets, competing with our business. I mean, it's been a disaster for Germany. The German auto industry has been decimated by competition from China.
There's been a lot of disappointment in China in terms of stimulus, and we know that the market was expecting a triple R cut at the end of 2024. That didn't happen. Now they say perhaps at the end of this month. I mean, how significant is that in terms of how it might play out in the market? Might that be a game changer or not?
Well, I think, if they took my advice, I would tell them that the government should kind of copy what the U.S. did during the pandemic, and that's try helicopter money, just send stimulus checks to households. I think the reason they don't want to do that is it could be very embarrassing if Chinese households don't spend that money on goods and services, but instead save it to kind of make up for the losses that they've taken in the real estate market. But they're running out of options here. Monetary policy has eased. The bond market's eased even more. And yet we just saw that the purchasing managers' indexes for manufacturing was relatively weak in December. The good news is the services was somewhat elevated, but it's a very volatile index. And all in all, all the data adds up to a relatively weak Chinese economy with a significant recession in the property market.
But the messaging out of China has been of confidence. Just earlier today, we had an official saying that they will continue to build on growth in 2025. I'm just wondering whether it's just a matter of time, just a matter of waiting for Trump's policies to get that clarity before perhaps we see QE or other stimulus that may come its way.
Yeah, I think the markets are taking a wait-and-see attitude. Maybe in the past, when the government had more credibility in its ability to stimulate the economy with fiscal and monetary policies, the markets would have reacted right away to the fiscal program that they've just recently announced. But the markets say, well, it's going to take a while before this actually gets implemented, and it's going to take a while to assess whether it's actually working. So I think that's the problem they're having with convincing the markets. And so far, the evidence for the markets is, there's not a lot of confidence that any of this is going to work.
When you take a look at Chinese assets, you take a look at the bonds, you take a look at the yuan and, the stock market, are they rightly reflecting the position of the economy right now, the weakness of the economy right now?
Are being realistic about what's going on there. We did see a rally on, as I said, at the end of last year, they did implement some monetary and credit stimulus. And monetary and credit stimulus, easy money, liquidity, typically tends to be bullish for stocks. But again, one of the key sectors is the property market, the stocks of the property developers. And they rallied, but now they're fading away. So that's just a sign of kind of the deep underlying problem. Look, the reality is that they've got a significant demographic issue with the rapidly aging population. And so they can build all the infrastructure they want, but old people don't go anywhere. They don't travel as much. They can't afford to spend a lot of money on airfare and on super fast railroads. So the infrastructure spending, they've got beautiful state-of-the-art infrastructure. I wish we had that in the United States, but they have more than the country can really use in terms of the population and their demands for those kind of infrastructures.
The thing is, Ed, this remains the second largest economy in the world. Can you afford not to be in the second largest economy in the world? And could China perhaps be a diversifier? Could it be a market that you diversify in for your portfolio?
Well, some would say that. And again, from a valuation standpoint, it certainly, even with a rally, is relatively cheap. But I'd like to see more freedom for entrepreneurial capitalism. It worked really well for about 20, 30 years. And I think that was really what drove the prosperity of China. And to step on the brakes on that kind of system that worked so well is unfortunate, because I think China is a great country, great people, hardworking people with great intelligence. The technological innovations are great. I just wish that the hostile relations between China and the Western world, particularly between the United States, but also Canada, Australia, I think it would be in everybody's best interest if we figured out how to calm everybody down, and instead of preparing for wars with each other, we learned how to work with each other. But that's a very John Lennon kind of notion. I guess you and I can sing the song, and it wouldn't make much difference at this point.
And at this point, as you say, China still remains uninvestable. Ed Yardeni, president of Yardeni Research, is sticking around. Well, we turn our focus next to India after stocks rallied at the beginning of the year to outperform the biggest Asian peers. But worries about a weak rupee persist. We'll get Ed's insights next. Keep it here with us. This is Bloomberg. Welcome back. 11:46. India's just kicked off its trading day. The Sensex and the other benchmarks in negative territory. But remember, India kicked off the year on a positive note. Today, though, not to be in terms of the Indian rupee. 85.78 is what we're looking at versus the USD. Pretty flat versus the greenback. Well, it may be all good for Indian stocks for now, but high interest rates, a waning pandemic-era spending boom, and a weak rupee are adding to headwinds. Let's get perspective from Ed Yardeni. Ed, of course, one day does not make a trend. Do you think there'll be a reversal in fortunes for India in 2025?
Well, India has done extremely well. And if you look at some of the metrics on the India MSCI stock price index, you think you were looking at the U.S. I mean, forward PE is around 22. The forward profit margin is around 12. Earnings have been increasing. It looks like a mirror image in some ways of the U.S. market. It's not cheap, but on the other hand, the fundamentals have been really quite good. And I wouldn't be surprised if the markets start to kind of trade in lockstep. So if you see weakness in the U.S., you'll see it in India. If you see strength in the U.S., you'll see it in India as well. But on top of all that, of course, India is a different country than the United States for sure, and they're going to have their own unique issues. But like the United States, maybe more so in terms of the potential, they have tremendous potential for consumer spending. And we've seen in many countries that when you have a strong consumer, you have a strong economy.
The problem is consumers are not spending. Urban consumption has been hit in a big way. And there are also other challenges like the strong USD, as well as the Fed's reluctance to perhaps ease monetary policy in a more significant way. These are all challenges for the Indian market.
Well, I think that putting it into context of our previous conversation, at the end of the day, India still remains categorized as an emerging market, and rightly so. And so when you, as you point out, when you have a strong dollar, when you have a situation where the currency is weak over there, then you do run into the reality that it's an emerging market and it's going to trade like one. At some point, it hasn't been trading like that for a while because the potential has been great, and a lot of money that had been looking at China or investing in China has gone to India. I think global investors are still going to stay committed to India. I mean, I know that the money's kind of flow in and out, and people look at that data very closely. But I think it's pretty hard for a global investor not to be invested in India these days, especially when you consider that the pool of exciting markets to be in the emerging world has narrowed quite a bit.
We know we've seen a pullback in the fourth quarter, but valuations still remain quite high. 12-month PE of about 2021. That makes it quite expensive, not quite attractive. But if you take a look at the intrinsic value for the longer term, what might look attractive in India?
Well, I think, round up the usual suspects if we're talking about sectors. Banks are a very good investment as the country continues to become more sophisticated in the financial sector and continues to grow wealth. Wealth creates lots of business for wealth managers, and so I think that is a good place to start in India. Anything consumer related, consumer retailers, I think is another area. I have a lot of high hopes for India's consumers. And I think they will see more prosperity as we get their economy continuing to grow and with productivity and profit margins expanding. So I think the consumer and banking, technology is an area that still has potential, but it's not there yet. Nobody really, as to my knowledge, gets terribly excited about the potential of investing in AI in India or data centers or the like, but that could clearly change. Look, the world is dynamic, and we are seeing that India and China are trying to mend the relationships, and while they continue to look hostily at one another in the Himalayas, the reality is they do depend on each other. The Indians buy a lot of goods from China, and China is going to discover that India is an important market for them.
And of course, in the final quarter of 2024, we saw that rotation of funds from India headed towards China. Do you see that reversing?
Not really, because I think a lot of that was because of expectations that the government in China is going to stimulate and that it would work. But I think as that becomes questionable, you'll see money that left India going back to India. So again, if you would, force me to tell you one or the other, I'd still stay with India, even though it's clearly more expensive.
Before we let you go, we have a final 3 minutes here, Ad. I'm just wondering if you could share your thoughts on some of the other assets. We saw how gold did really well in 2024. That's, of course, on the back of expectations that, things could go wrong in 2025. Where do you see gold headed? What assumptions are you making?
Well, I think the case for gold has actually been a fairly straightforward, simple one, and that is ever since ever since Russia invaded Ukraine and the West put sanctions on Russia and confiscated their reserves, we see that lots of countries have decided maybe they have to have more of their reserves in gold and less in dollars. Particularly the countries that are fundamentally antagonistic to the United States. And so countries like Korea, like Russia, like Venezuela, like Iran are probably buying more gold. China's been buying more gold, and I think it's really that simple. So we really would need to see global geopolitical tensions calm down pretty significantly to cause a decline in the price of gold. And that realistically doesn't look like it's going to happen anytime soon, in which case I think gold has the potential for going to $3,000 an ounce.
And the final question for you, Ad, is on Bitcoin. I mean, surging past $100,000. You've likened Bitcoin to digital tulips. I mean, what do you make of that rally, and where do you see it headed in the year ahead?
Well, when I say digital tulips, I'm sure I come across as saying it's a speculative bubble, which I think in some ways it is. But the big difference between the tulip mania in Amsterdam and what we're seeing now is Amsterdam was a fairly small market, and it was only open during the day. A digital tulip market is open 24 hours a day on a global basis with a global market. But I think Bitcoin investors, cryptocurrency investors have to increasingly be concerned about another new technology, which is quantum computing. We may have computing power pretty shortly that can break encryption codes. And suddenly you think you're a multimillionaire in Bitcoin, and suddenly you try to find your account and it's not there anymore.
Ed, thank you so much for spending your time with us today. Ed Yardeni, President of Yardeni Research. Let's take a quick look at how cryptocurrencies are headed right now. Bitcoin currently down about 1/10 of 1%, 96,989, quite far away from that $100,000 that we saw in 2024, but ain't too shabby either, in positive territory. Now, before we go, here's a look at our guests for next week. On Monday, we'll be joined by Goldman Sachs Chief Asia Pacific Equity Strategist. We're talking about Tim Mo. Malaysia's Economy Minister Rafizi Ramli will also be joining us. That's happening on Thursday from the Malaysian Economic Forum. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.